about content any day. Last week we talked some about the accounting equation, the basic accounting equation, the types of transactions that would influence it, that would change it. If you would imagine a busy business, there's one right across the street that's not difficult to imagine. Can you imagine Walmart recording transactions the way we did last week? What did we do? 8, 10, 12 transactions in a homework problem and thought, oh, how long and oh, how hard that is. Y'all with me here? Can you imagine recording that many a minute? 24 hours a day? Come on, say you're with me. Let your faces show you're with me. We need to get better at this, and getting better at this, in my opinion, is maybe a 3 or 4 step process. This is one step in going where we're ultimately going and keeping it on the computer. This is what happens behind the scenes that is conceptual and that we need to understand. Everything we do in accounting is important. I can think of nothing more important than this week and this lecture. In terms of your success, it is critical that you catch on this week and today. There is no reason that you can't catch on to this today in class while we're here. And I hope you will. Think all hour long. See the pictures, but think. Hear the concepts. And learn in class today. And then look for opportunities to apply that all week long. Let's glance back. You're supposed to know the accounting equation for me. If I had asked you before I flashed it on the screen just then, could you have said it to me? Say yes or no.
Yes.
If you can't say the basic accounting equation right now, you're in a hole and you need to get out quickly. We improved that a bit. We said there are specific things in each of those categories. When you did homework problems, you had categories of assets, cash, accounts receivable, equipment. You may have had more than one liability, accounts payable, notes payable, those kinds of things. And then you even used the expanded accounting equation, the one that had a few more columns on it to record transactions. I'm sticking with the basic one. We'll touch on that. I contend that that's still true and will be true in every page of this textbook. It's just not the most efficient way to write it down. We could improve the process some if we were to take each of those columns in which you recorded transactions and converted each of those columns to a page in a book that we could use exclusively for that purpose. If you want to fast forward the tape, we could convert it to a file in the computer, a database. Y'all with me or not?
Yes.
But we're taking baby steps here, a big baby step. We're going to convert each of those columns, each of the things that we needed to record, into one separate page in a book. And we need on that page a place for recording the things that we recorded this last week. We need to know its name. We need to know how to record increases. We need to know how to record decreases. Let's design the page in such a way that we can accomplish that. Now, let's take a closer look at one of those pages. It reminds you of which letter of the alphabet? Everybody said
T.
That's a T. That's a T account. It's really an account. It's shaped like a T and we call it a T account. It's an account. And it has exactly those things that I described as characteristics. If this is an account and this is accounting, y'all get where I'm going here? This must be important. The whole process is named for this little critter right here. An account that has a horizontal line that would be a great place for recording its name. Cash, equipment, accounts receivable, accounts payable, and so forth. It has a vertical line for separating increases and decreases. One of the things that you had to do last week was be sure and write down the sign. Some of you didn't write down pluses because that was assumed, but you were careful about writing minuses, weren't you? In order to know how to treat that transaction, how to sum the column, how to make sure you were in balance. It was important, and it's still important. But no need for writing pluses or minuses anymore because we've got a vertical line that separates two sides. One side of this is for recording increases. One side of this is for recording decreases. It's that simple. That's pretty simple, isn't it? Yes or no?
Yes.
So our job today is to decide which side is increase and which side is decrease. I want to go on record right this minute as saying either side could be increase. The left side could be increase or decrease. The right side could be increase or decrease. What we've got to do is decide what to do. Either side could be increase. Either side could be decrease. It's not as arbitrary as I'm pretending, but it is somewhat arbitrary. It makes sense. There is some logic to it. Let me test your logic. If I said the left side were increase, which side would be decrease?
Right.
That didn't take a mental giant, did it? It's that simple. Once we know the increase side, we also know the decrease side. Yes?
Yes.
If this side, the right side, is the increase side, which side is the decrease side? The left side is. I think you got it. Either side can be the increase side. Either side can be the decrease side. We need to decide. I'm struggling a little bit with this left and right thing. It seems to me that every person in the room has the same left and right this minute, except one goofy oddball, a nonconformist. Is anybody with me right this minute? You think I'm calling somebody in your names if you didn't catch on. Left and right isn't the same for every person in this room. Left and right is not a good way to describe the two sides of this account. It is true, however, that for every person in the room, that's east and that's west. Let's call them east and west from now on, shall we? That'd be true until we, if we went to the library to study, we'd have to start calling them north and south. How chaotic would that be? We don't want chaos. We want calm. We want you to understand. Left and right are not good names, and east and west are not good names, and north and south are not good names for this. I don't know if it was Pacioli himself, but somebody beat us to the punch. Somebody named these two sides debit and credit. Debit means the left side of an account. Credit means the right side of an account. And that's all they mean. If you brought some extra baggage into the room thinking of some preconceived notion about debit or credit, then I need to destroy that myth in your mind and substitute this one. When paired with other information, they could mean increase or decrease. But by themselves, they mean the left side of an account and the right side of an account. Debit is the left side of an account and credit is the right side of an account, and that's all they mean. Last week's emphasis was on the basic accounting equation. This week's emphasis is on the account. I would like to combine last week's lesson and the importance, the stress we put on it of keeping the equation in balance with this week's lesson of drawing that T account directly under that equal sign for this logic. Will you be with me right now? Yes?
Yes.
Are you ready for this?
Yes.
Since assets were on the left side of the equation, we're going to give them the left side of the account to be their increased side. Assets are increased with a debit. If assets are increased with a debit, how would you decrease an asset? Everybody in the room that knows said. If assets are increased with a debit, how are they decreased? Say something.
Credit.
Thank you. Hear the logic. Since liabilities and owner's equity are on the right side of the equation, let's give them the right side of the account to be their increased side. Liabilities are increased with a credit. How do you decrease liabilities? Say something.
Debit.
Good. Are you with me right this minute? Let us not get caught up in all this. Let's see how simple it is and learn it and remember it. Since owner's equity is on the right side of the equation, let's give owner's equity the right side of the account to be the increased side. Owner's equity is increased with a credit and it's decreased with a debit. Who's with me right this minute? Hands up. Great. Last week, you might have recorded a transaction this way. Had it been in the basic accounting equation and not the expanded accounting equation, there are two possible things that you could have read in the book that would have caused you to react this way. May I have two volunteers? What did the book say that caused you to write it down like this in the green shirt?
It told us that that's what the equation was, and so we put in that you increase cash on the asset side and increase revenue on the liability side.
I'm going to take that as the right answer. It wasn't exactly how I wanted to hear it, but I think that if the book had read, we did work for cash, what he just said was true. Receive cash for services performed. Y'all with me or not?
Yes.
We would have increased cash and you would have, in your homework, increased revenue, but I don't want to do it that way. Remember, I like the basic accounting equation better. Increase asset, increase owner's equity was our response to the book's stimulus. The owner, or we, the business, performed services for cash or on account. Would have been the same entry. The book could have said something else. Almost every problem we did last week started this way. What might the book have said to record you, get you to record something like this? I need a hand up. I need you fast. Right here on the front row, Daniel.
So-and-so invested $10,000 in their business.
Owner invested in the business. Would increase cash and increase owner's equity by the amount invested. We would have recorded it this way. And what we're trying to move away from is this slow, inefficient way to record things. The whole premise this week is refining the process, getting better. Last week, every transaction had two effects on the accounting equation. This week, I promise you that every entry will have at least one debit and one credit, and they will balance. It may have more than one debit. It may have more than one credit. The sum of all the debits will equal the sum of all the credits. In every journal entry, debits and credits have to equal. That's a wonderful assurance that we have. When we recorded something like the illustration at the top of the screen last week, now we know we could record it this way. Debiting assets will increase them. Crediting owner's equity will increase it. That's the same thing. That's just two different ways to write it down. This is the way we're going to write it down this week. What I just described to you in the last few minutes was what we call normal balances. Normal balances are where we would expect to find the balance of the account. Normal balances are the increased side of the account. You just heard me describe the normal balances for the primary three kinds of accounts in the accounting equation. I would like to write it differently for you. I'd like us to make a list that perhaps we could refer to. So what we've established is that assets have debit balances, that liabilities have credit balances, and owner's equity has a credit balance. Now, I'm not a Roman numeral kind of teacher. I'm not an outline kind of teacher. But if I were teaching an outline today, I'd say this is Roman numeral 1. The relationship between the type of account and the accounting equation is how we establish the normal balance of these three. If you forget, I think I've given you logic today that you shouldn't forget. If you forget, then Roman numeral 1 is the accounting equation and the T account right underneath it. Assets are on the left, they have a debit balance. Liabilities and owner's equity on the right, they have a credit balance. That's what we've established. Now, before the days of note-taking guides, when I knew people were taking notes, I'd say, okay, skip 2 lines, we're coming back, and we're going to fill in those 2 lines in a second. The key to this normal balance idea is that any account can be increased by doing the same as its normal balance. And any account can be decreased by doing the opposite of its normal balance. Increase same, decrease opposite. Let's see if you understand that. I'm going to ask for answers in unison. When I drop my hand, give me a big hearty group response, okay? How do you increase an asset? Did I drop my hand yet? I was allowing you a moment to think. How do you increase an asset? I'm not sure I heard a consistent answer. I hope you said debit. How do you increase a liability?
Credit.
How do you decrease owner's equity?
Debit.
I hear some people saying both real fast. They don't like to miss it. That doesn't count. How do you decrease an asset?
Credit.
Increase a liability?
Credit.
What I just heard you do was carrying out this increase same, decrease opposite idea. Any account can be increased by doing the same as its normal balance. Any account can be decreased by doing the opposite. We've established that today, and I'm just having you practice it in order to become more fluent at it. Think about it until you don't have to think about it anymore. You accept it. It's true. Now let's talk about the 2 missing lines. Let's look at capital more specifically. This is where the book might have led you astray in asking you to do the whole thing. So we had the basic accounting equation last week, but in your homework you did the whole thing. And those changes that you made out beside the owner's equity column were things that affected owner's equity. And that's exactly what I want to talk about right this minute. Here's where it belonged, in my opinion, not in chapter 1. Let's take a closer look at capital. Tell me about capital's balance. Is it debit or credit? Say something.
Credit.
Come on, everybody say.
Credit.
It's credit. It's increased with a credit. It's decreased with a debit. Yes?
Yes.
We established that in Roman numeral 1 based on capital's relationship to the accounting equation. It's increased with a credit. It's decreased with a debit. If we had done the basic accounting equation only all last week, capital would have become cluttered. If you were in my discussions and first discussion last week, we did it and we learned to write explanations out beside the clutter. We didn't have 3 extra columns to put things in like you did in your homework. Capital would become cluttered, but if you step away from that, you notice that it seems there are only 4 reasons that capital ever changes. If you know those 4 reasons that capital ever changes, would you name them with me right this minute? In order. Go. Investments, withdrawals, revenue, and expense. Thank you very much. So, instead of entering them directly in capital, we're going to enter one of them directly in capital, investments by the owner. And we're going to have special places, drawing, revenue, and expense, to enter other changes that occur in capital, just like the expanded accounting equation that you used in last week's homework. Now it's all coming together. We need revenue accounts that are part of owner's equity. That's the lesson you might have missed with the expanded accounting equation. We need revenue accounts to take care of some of the volume. Many of the transactions that we enter into are going to affect revenue. Revenue is attempting to take the place of the credit side of capital. Revenue increases capital. Revenue's normal balance, therefore, is credit. Entering something in revenue is like entering it in capital. Now, if you've got revenue accounts and you enter it in capital, then you're cluttering capital when you shouldn't. Only investments by the owner should be entered in capital. If you perform services for a client, customer, then you should record that revenue that you earned for the work that you did in a revenue account. Revenue's balance is credit. It's increased with a credit. It's decreased with a debit. Revenue increases capital in the long run. Revenue doesn't exist unless there's capital existing. Revenue is connected to capital. It's a temporary capital account. Expenses and revenue are alike or opposite. Say something. Expenses and revenue are opposite. Revenue increases capital, expenses decrease capital. The decreased side of capital is debit. Therefore, expenses have debit balances. Expenses are increased with a debit and decreased with a credit. Entering something in an expense increases that account. We want to know. One of the reasons we're keeping score is to measure how profitable we've been. We want to prepare an income statement at the end of the year. We want to know the total of all the revenue, and we want to know the total of each of the expenses, and we want to know the total of all the expenses. It's no wonder that when we debit expense, it increases that account. Our job is to know how much we've incurred in expense all year long. And that account is going to accumulate that. Expenses decrease capital. Expenses are temporary capital accounts. But if you enter something in capital that should be entered in an expense, you get the right answer, but it's not the best answer. Capital's cluttered, and that's technically wrong. We want to enter them in the right place. Now what I just did, let's do one thing. Drawing is like expense. Drawing decreases expenses. Expenses have a revenue connection. Expenses should help us earn revenue. Drawing is for the owner's personal expenses and has no business connection. Expenses go on the income statement. Drawing doesn't. Expenses and drawing have some characteristics that are alike and some that are different. Drawing decreases capital, like expenses decrease capital. Since expenses and drawing decrease capital, they have debit balances. Drawing's balance is debit. It's increased with a debit. It's decreased with a credit. It's a temporary capital account. Yes, sir.
I think our sign sheet is on the desk.
We knew 3 balances of accounts in Roman numeral 1. This concludes Roman numeral 2. To the original list, I'd like to add the 2 primary ones we just discovered. I had you skip 2 lines a minute ago. We know the balances of assets, liabilities, and owner's equity because of their relationship to the accounting equation. We know the balances on these 2 lines for revenue and expense because of their relationship to capital. We now know that revenue's balance is credit. We now know that expenses balance are debit. We know that any account can be increased by doing the same as its balance. And any account can be decreased by doing the opposite of its balance. Could you show me that you understand this? I'm going to ask you a bunch. You have to listen carefully. I'm going to give you a moment to think and ask for a big, hearty group response. Everybody ought to try. How do you decrease an asset?
Credit.
How do you increase owner's equity?
Credit.
How do you increase revenue?
Credit.
How do you decrease an expense?
Credit.
We could sit here the rest of the day and do this, couldn't we? I think you're doing a nice job. Are you with me right this minute?
Yes.
Obviously, you need lots of practice. If you need a crutch, then make you a little note card and put it in the palm of your hand while you're doing your homework this week. And as you translate what the book says to the response that you're expected to give in your homework, maybe you want this list: assets, debits, liabilities, credit, capital, credit, revenue, credit, expenses, debit, in your hand. Maybe you want to use it as a crutch for just a little while. The sooner you can put that away, the sooner it's in your brain, the sooner that you can answer it correctly every time you're asked to answer it, the better off you're going to be. We're laying the groundwork for things we'll use in chapter 25. This concept goes all through the book. You need to know it this week. I think you know it right this minute. Find places to use it. So, what I just presented to you is a list of 5 categories, 5 kinds of accounts. And I would like for you to know their normal balances. I would like for you to be able to look at an account and know what it is. Is it an asset, liability, capital, revenue, or expense? If you're to know its normal balance, how can you know its normal balance if you don't know what it is? If you don't know its classification? Let's practice. I'll name an account. You tell me what it is. Asset, liability, capital, revenue, expense. What's cash?
Asset.
Accounts payable.
Liability.
John Doe capital. You can say capital, you can say owner's equity. They're both right. Service revenue.
Revenue.
Rent expense.
Expense.
How are you doing? You've got to know what kind of an account it is. If you know what kind of an account it is, then you know its normal balance based on what we've accomplished today. I'd like for you to know 2 ways to classify an account. Every account, except one, goes on either the balance sheet or the income statement. Now, we're not going to do balance sheets and income statements this week. We did them last week. We're going to do them next week. Wouldn't it be a crying shame for you to forget what little bit you knew last week about the financial statements? Don't do that. We're going to bring it up from time to time this week to remind you. We know where we're going. You need to recognize them on sight. I'm going to give you a list of accounts right this minute. Your response is to be balance sheet or income statement. Ready? Cash. Accounts payable. John Doe capital. John Doe capital goes on the balance sheet. How would the balance sheet balance without John Doe capital? With me? Service revenue. Rent expense. It was the same list I gave you a second ago. A second ago, the responses were asset, liability, capital, revenue, expense. But this time, you answered whether they went on the balance sheet or the income statement. Start thinking that way. Start classifying them. That's our ultimate communication device. We want to tell others about our business. We're going to do it through the financial statements that we prepare. We need to start seeing that completed in our minds. Seeing the impact of this transaction on the account and ultimately on the financial statement. That's what we're trying to develop. I'd like for you to know about classifying accounts 5 ways, 2 ways, and 2 ways. Every account, except one, can be classified as either real or nominal. The issue here we're trying to address is, what are we going to do with this account at the end of the year? Some accounts we just carry on, keep going. Some accounts we stop and start again. Real and nominal are good words, but synonyms for them that would help you understand their nature would be permanent and temporary. Permanent accounts we always have around. Permanent accounts just keep going. Kind of like the Energizer Bunny. But real accounts stop, get reset to 0, and then we begin again. Now, this is a harder concept than it needs to be right this minute. Could you talk to me a minute about this? Maybe not as a group, but maybe one individual or so? Let's pretend that your business has $6,000 in the business bank account on December 31st. How much cash does your business have in its business bank account January 1st? One person? Say it, somebody.
6,000.
6,000, Talon, thank you. Is cash real or nominal?
Real.
Speak up.
Real.
We just kept on going. Customers owed you $8,000. The balance of accounts receivable on December 31st is $8,000. What's the balance of accounts receivable January 1st? $8,000. Not the year of Jubilee? You gonna forgive them of their debts as we forgive our debtors? Ooh, well, maybe it wasn't talking about that. Y'all with me here or not?
Yeah.
That's a tough one. So the balance of accounts payable is $3,000 December 31st. What's its balance January the 1st?
$3,000.
Oh, that they would forgive us of that. $3,000. Is accounts payable real or nominal?
Real.
Real. Service revenues balance is $56,000 on December 31st. What's its balance January 1st? I need a hand up. Yes, sir?
0.
Why? Thank you. The purpose of service revenue was to accumulate information, and we did. We increased it all year long. Its balance is $56,000. We're going to prepare an income statement. We're going to measure how we did that year, and we're going to stop and start over. The balance on January 1st should be 0. It's nominal. Do you see the point I'm trying to make?
Yeah.
The balance on rent expense is $12,000 December 31st. What's its balance January 1st? Everybody that knows said
0.
the purpose of rent expense was to accumulate information for 1 year. Once we know that balance, we can prepare an income statement, we can determine net income, and we can start over January 1st with a clean slate, counting again, accumulating again, determining again. Is rent expense real or nominal? It's nominal. During the week, as you're introduced to new accounts, as you learn their balances, as you become fluent in knowing how to increase them and decrease them, think beyond that. Think, on which financial statement do these accounts go? What am I going to do with this account at the end of the year? Am I going to keep going? Real. Or am I going to stop and start over? Nominal. Who's with me right this minute? Let me see. Good. So, we've noticed there's a pattern. in what we do in business. We notice that when we have transactions that we have to write them down quickly, a cash register receipt, an invoice, a purchase order, a check, our book is describing source documents to us. Our book's the source document for us, but in real life we'd have real source documents. It's our job to analyze those source documents, to think about them. To think about them as only we can. Computers can't do this part. And express them in terms that the accounting system can understand. We call that journalizing. We're going to write them down for the first time in a journal. And we're going to transcribe that same information to the ledger. That's called posting. I'd like to illustrate journalizing and posting to you. We're going to write in 2 books, accounting-wise. The journal is the book of original entry. That's the first time we write it down in terms that the accounting system can understand. The book of accounts, where cash, accounts receivable, accounts payable, John Doe capital, service revenue, and rent expense live, is called a ledger, a book of accounts. If we think back to first or second slide today, I told you that the way we used to do it wasn't the best way to do it. We were going to make each of those columns become a page. If I put all those pages in one book, that'd be the ledger, the book of accounts. Let's talk about what we need to do. These instructions that you're about to hear are going to help you do your homework. Let's pretend that we're considering the transactions of a company who just started business. We want to record the transactions as journal entries. Now, if you need to record them in terms of the accounting equation just to have a connection with last week and realize they're the same thing, that'd be a good way to start this week. But eventually we want to put down the old ways and pick up the new ways. If you read in the book this week that said, we bought equipment on account, maybe you want to think about last week first. Maybe you want to consider, well, last week I would have increased assets and increased liabilities. I have more equipment and more accounts payable than I did before, yes or no? Yes. That's the way you should have known how to do it when you walked in the room today. How can we translate that to this week? The first time we make a journal entry, we write the year. And we use about half that space. On Excel, that's hard to do, or impossible. But when we were writing and writing, we put it in the upper portion of that cell. And if the year stayed the same, we didn't ever write the year anymore. We write the month, the first time in that month. We write the day every time we start a new transaction, even if it's the same day. How can we accomplish purchase equipment on account in terms of a debit and a credit? I want to increase assets. I want to increase liabilities. I'm going to increase assets by debiting them. I'm going to increase liabilities by crediting them. Hear me out. Here are our traditions. We always write debits first. It's a tradition. We always write debits against the margin. We always write all the debits first. If there is more than one debit, we write them all against the margin. We indent once and write all the credits. Do you see those characteristics in the illustration on the screen and say yes or no?
Yes.
Always write debits first. Write the debits against the margin. Indent the credits one time, a thumb's width or something. Half inch. Something. That way, visually, we can see what was debited and what was credited without our eyes falling way over here to figure out the amounts. We know in a glance which of those is a debit and which of those is a credit. The tradition is that in this format, we write explanations. I'm about to make a deal with you. If you'll show me in 2.1a that you know to write explanations, I will forgive you from writing explanations the rest of the year. Is that a good idea? A good deal?
Yes, sir.
Will you do that for me then?
Yes.
If you've already done 2.1a and didn't write explanations, then go back and squeeze them in. You need to show me in 2.1a, just one time this year, you need to show me that you know to write explanations. Then after that, you may skip a line instead of writing explanations. Did you hear that?
Yes.
Please, I'm begging you, skip a line between your journal entries so that you can see them better, so that we can see them better.
Let's practice journalizing one additional entry described in the handout. On the 3rd, $500 cash is paid to the landlord for June rent. How would this transaction be recorded in the journal? Since it is the same year and the same month, neither year nor month is entered in the journal for this transaction. Only the day of the month is entered, the 3rd. In Chapter 1, we would have decreased the asset cash and decreased owner's equity for rent expense. In the new format, the journal entry would credit cash to decrease cash. By debiting rent expense, we would increase rent expense and decrease owner's equity.
I want to post the entry we just made. Journalizing is what I've described. Write the debit first, write the credit afterwards, indent the credit. That's journalizing. Posting is transcribing that information. Let all the cash transactions wind up in the same place. Let all the accounts receivable transactions wind up in the same place. Summarize them, group them together, get results. Let's describe posting from the journal to the ledger. The first time you make an entry in an account, you write the year. If it stays the same, you don't write the year anymore. The first time you make an entry in the account, you write the month. If the month stays the same, you don't write the month anymore. You write the day of the month with each transaction you post. As I journalized this transaction, I decided it was a debit. That's where the analysis took place, the thinking. There is no thinking in posting to equipment. When you post to equipment, if it was a debit in the journal, it is a debit. No arguing. That's what you decided when you journalized it. We're going to enter this entry as a debit. Now there's a mechanism that we call posting reference that connects things together, that provides us some valuable information at times. When you have completed posting that debit, you look at the account number here. I made this up. And you enter that account number in the posting reference column to indicate that you have posted. That means you finished. But in the account, you also enter J1 in this case, the page number. So in the equipment account, you would enter J1, meaning that's where it came from. If I wanted more information, I could look at J1 and see that I did it there. Then the last thing you do, I've already said, is return that account number to the last thing you do is enter that posting reference. Some of you will be tempted to enter that posting reference number as you journalize it, and that's not the point. This is like completion, like putting a check mark, like crossing through something on your to-do list, providing that cross-reference mechanism. Have a nice day and a nice week.